Today's topic is on investing. The opportunity to access prosperity has never been greater than at this moment in time. Notable wealth can be gained by contributing to and accessing the profitability of America's top businesses. Sadly, only one-third of all millennials currently in the age range of 23 to 39 are investing for retirement. Unfortunately, their inaction, even so early in their lives, will greatly diminish the likelihood that they will ever access prosperity. The main purpose of this presentation is that you do not miss out on this extraordinary opportunity. It's important to remember that when you start your first full-time job that will allow you to live on your own, you should start investing at least 10% of your income. If you execute accordingly, the rewards will be great. An investment is that which is purchased with the hope that it will increase in value and provide income in the future. It is the purchase of goods not consumed today, but used to create wealth in the future. One of the main obstacles in motivating people to invest is that it involves directing current income for future benefits. It can be difficult to look beyond the challenges of today, but we can make it easier to invest if we set up our investing in an automated manner, similar to the way in which the government takes our taxes automatically out of our pay without any effort on our part. Today's objectives will be to understand what investments are and how they can help you to achieve your financial goals, understand risk versus return and diversification, learn about common types of investments, and understand common options for retirement savings. The reason investing should be discussed even with students that have yet to start working full-time is that it is critical to start investing as soon as you begin working full-time so that you will be able to capture the benefits of compound interest. Compound interest has been referred to as the eighth wonder of the world. We will discuss the three types of investments that you'll need to place you on a firm financial foundation for the rest of your life. A savings account is an excellent place for your emergency fund. It will not fluctuate in value and it will be easily accessible if needed. Savings accounts are also excellent for setting aside money for short-term goals, specifically any goal that you would like to attain in less than 5 years. A bond is essentially a loan to an issuer, which is either a corporation or the government. Bonds are issued by federal, state, and local governments as well as corporations. The bond promises the issuer will repay the investment and pay a fixed percentage of interest until it is redeemed or sold. Bonds provide stability in an older person's portfolio, but are not needed for a younger person, as the rate of return is very modest and they are not as easy to access as a savings account. Buying a stock makes you a part owner of a company. The reason a company allows you the opportunity to become a part owner, a shareholder of their stock, is because they believe they have a product that has great potential demand, but they do not have the money to build the manufacturing facilities and or hire the workers to make the product fast enough to meet the anticipated demand. If a company becomes profitable, the value of the price of their stock will increase, and accordingly the shareholders will also benefit. If a company goes out of business, the shareholder will lose all of the money that they used to buy the stock, and their investment would become worthless. To avoid the hazard of losing all of your investment in one stock, it is now possible to invest in the stock of many companies all at once through a mutual fund. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks and bonds. Investors direct their investing dollars to an investment company that purchases stocks and other assets on their behalf. The investor is combining their investment dollars with the dollars of other individuals so that they are able to access many companies' stocks all at once. Mutual funds have just recently become easily and inexpensively accessible to the general public in the last 30 years. This has been a key factor in the ability of almost all Americans to be able to contribute to and benefit in the prosperity of the best of America's businesses. Over the last 100 years, the top companies in the United States have delivered on average 10% annual returns in 30 and 40-year investment timeframes. So even though past performance is not a guarantee of future results, the probability that a person that begins investing in America's top companies when they start working full-time will earn the 10% annual returns over the course of their working life is high. A market index is an aggregate value produced by combining several stocks or other investment vehicles to track market changes over time. Normally, when you hear on the news that the market is down, it is referring to the Dow Jones Industrial Average. The Dow is widely used as an indicator of the health of of our economy. Only 30 companies represent the Dow. Dow companies are easily recognizable by many consumers. Examples are Apple, Chevron, Coca-Cola, Disney, McDonald's, Microsoft, Nike, Visa, and Walmart. The Standard & Poor's 500, S&P 500, is another index. This index includes the top 500 companies publicly traded and, as such, provides a greater representation of the market. All of the companies that are in the Dow 30 are a part of the S&P 500 index. In 1976, the Index 500 fund was invented, which allowed access for small investors to easily invest in the top 500 companies in America. A person today can begin to invest in an Index 500 fund with as little as $50. This graph indicates the returns of the Dow 30 and S&P 500 from 1902 to 2014. As you can see, the value of these American companies has been going up over the last 100 years, but there have been drops, but there have been periods when the value of these indices has dropped. Since the market can drop at any time, it's important to not have any money that you would like to use in the next 5 years in the stock market. In almost all cases, if the market drops in value, it will return to its previous value within 5 years. This rule of thumb works well at all ages of life. The investment strategy known as dollar cost averaging helps to ease the emotional roller coaster of investing and keep your hard-earned dollars working for you. Dollar cost averaging is a simple practice that involves setting a set amount of money each month into your investment and retirement accounts. When you start to work, you will want to start automatically investing at least 10% of your paycheck. As previously mentioned, an Index 500 mutual fund is a great investment to utilize. Imagine you start at a job after college making $48,000 a year, which is $4,000 per month. If you invest 10% of the $4,000, you will be investing $400 per month. Of course, we want the share price of our Index 500 fund to go up over time. But when the stock market drops in value, you'll note that you automatically buy more shares during these market dips. When the market goes back up, the value of your overall investment will increase all the more. This example will show the impact of starting your investments as soon as you start to work full-time. This scenario asks the question, if a person starts to invest $200 per month in an Index 500 fund at age 20 and then stopped at age 30 and then left that investment alone until age 60, would they be further ahead compared to a person that waited until they were 30 to start investing but invested $200 per month for 30 years? The first person invests a total of $24,000 over a 10-year period, while the second person invests a total of $72,000 over a 30-year period. Can you guess which one would be farther ahead at age 60? Amazingly, the person that starts 10 years earlier will have a portfolio that is nearly double the person that invests 3 times more money but starts 10 years later. This is the result of the eighth wonder of the world, compound interest. Hopefully this will provide a strong incentive for you to start investing as soon as you start your first full-time job. Some companies provide their employees the opportunity to automatically invest a portion of their paycheck. Companies that offer 401ks many times will also provide a match to your investment. For example, if a company provides a 5% match and the employee invests 5% of their paycheck into the Index 500, their company will provide an additional 5% into that same investment for free. If you invest 10% and the company matches to 5%, you would then be investing a total of 15% into your selected investment. Not all companies offer 401ks. If your company does not offer a 401k, you can easily invest in an IRA, an individual retirement account, by setting up an automatic withdrawal from your debit account to an investment company's Index 500 fund. Key takeaways. As soon as you start working full-time, immediately start investing at least 10% of your income and continue to do this your entire working life. The Index 500 fund is a very understandable and great investment to utilize. Don't let emotions drive your decisions. Remember, when the market drops, you're just buying more shares of your investment, which will greatly enhance your portfolio in later years. When you're interviewing for your first full-time job, ask the potential employer if they have a 401k and do they have a match. If you execute on this advice, it is likely you will have a net worth that is in the top 10% of all Americans when you retire in your 60s, and you'll have the opportunity to have an outstanding life in retirement.